Good afternoon, welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is January 25th, 2024, and we're going to discuss, will PCE reaffirm high inflation? Before we get into the details, let's go ahead and look at the ES. A couple things we saw in the reaction, the behavior in the market. We've talked a lot about volume over the last couple of weeks, and you can see that yesterday's spike higher, the new record highs, settled in to close flat on average volume. So we know that this attempted move higher was met with a new barrier. And so we could not clear 33. We closed flat for the day on average volume. Right now we're going to come in just shy of average volume, but we're also creating consolidation. We've got lower highs and higher lows. So the question is, are we already finding a top in this market? And are we going to see that market confirm the top with tomorrow's PCE? PCE, personal consumption expenditure, is used more by the Fed to determine inflation and consumer behavior than even CPI or PPI. If we look at the ES and compare the movements up and down with inflationary prices this time we'll use gold versus the bond market. And we do that by going into studies, edit studies, and we're going to do a price comparison or a price ratio. So this price ratio, we will compare the difference in gold as an inflation hedge, since we're talking about inflation specifically as an investment, gold versus bonds. And bonds, we'll use the 10-year. Bonds are considered the risk-free premium, or in other words, the way to invest that doesn't have the same exposure. Now we know that there's some risk in bonds, but right now we're going to treat it as the risk-free premium. And we're going to look at this ratio not just today, but over time. We can see that we hit these record highs in the ratio between gold as a hedge for inflation and bonds. That would be theoretically the peak inflation, and that's about where we did see peak inflation. We saw peak inflation back last year, and since then CPI numbers have been showing that the rate that inflation is going is slowing. But with where we're at gold versus bonds, you can see we are way up here still above 18. Despite the fact that we're not at record highs, we are holding at these very high levels. We have not been at 18 in the last year other than that little time frame there. Let's go ahead 3 years and look back 3 years, and you can see this is anything but a reversal. We're just consolidating, holding inflation levels high. Go back even further. And this is 20-year monthly, and we don't report CPI and PPI except for once a month. Same thing with PCE, so this would be a good opportunity to look at this as the expectation. From 2005, this ratio between gold and bonds has gone from 4 to 18, and now we can see month to month, we put in a peak. We have not put in a lower low. We're still in an uptrend. Higher high, higher low, higher high, higher low. If we look at core PCE and look at the graph, some of the history, you can see that we've maintained anything positive is inflationary pressure. It's just whether it's high inflationary pressure or low inflationary pressure, anything negative is contraction. And so personal consumption expenditure price index is showing that prices fell in 2020 and fell slightly to 0% in December of 2020. But reality is we didn't see anything negative since that May 2020 timeframe. And we're expected to see it go from 0.1 back up to 0.2. If it comes in hotter than that, there will be zero justification to see rate cuts. As we're looking at this move higher and the fact that we've been positive for now going on 4 years, every time this is month over month, year over year growth, this is all adding to inflationary pressure. And yet, despite that, you can see even in the news, U.S. Treasury Secretary Yellen, inflation is coming well under control. The problem is the data doesn't seem to show that. Prices at the grocery store don't show that. The only thing that shows that it's come under control, inflation's under control, is oil prices. And since we already have this set to the 20-year monthly, we'll just look at the month-to-month difference. And we can certainly look back and say oil prices in US dollar. Obviously, in 2008, when oil hit 147 a barrel, we pulled way back. But inflation has been very strong, very high since the lockdowns in 2020, where it went to $6.50 a barrel. climbed all the way up to 131. We pulled back to key support. You can see over 2.5 years that this is the key level, 66, 66, 66, 66, and held at support. But since we're talking about personal consumption expenditure price index from the previous month, and we're looking at the difference there, from last month to this month, the difference here is this candle. The open price was 71.71 for January, and we're already at 77. That's 8%, an 8% increase in oil prices. Let's go to a shorter time period. We can see that a little bit better. You can see that rounding up and climbing 8%. Now, I thought we'd stay below 76. I've talked about that for months, 76.66, 76.66. But today was enough to break it free and move it all up to 77.37. This is inflationary. This is going to add to the cost of transportation, not just retail gas prices, but transportation, plastics, anything that you have delivered is going to have this impact of oil getting all the way back up to 77.36. So we are far from seeing inflation under control. So then my question is, if inflation is still high and if it's still running hot, will we see the adjustment in predictions of rate cuts? Will we see changes in consumers' purchasing behavior? And that's going to be the bigger deal, and that's what PCE is attempting to do. Personal consumption expenditure attempts to define not just prices, but how we perform. Now, if you recall, we were looking at rate cuts that we're possibly going to do 2 rate cuts in March, but likely in May. If we look out to May, we're still seeing about 50% probability of 1 rate cut and about 40% of second. So we've gone way down. It actually was much higher. We had 73% probability of that second rate cut by May, and now we're down to 40%. So we're seeing that slowly slide away. And yesterday it actually was only 28%. So we are seeing that unwind. And if we see inflation continuing to hold up, then that is going to justify them not cutting rates at all. And I don't think that we're going to see the rate cut in March unless they feel like they have to kowtow to the markets. Now, if we look at Visa, Visa's still the #1 thing I like to look at for consumer purchases and transactions. It's not amount of credit card debt, it's the number of transactions. And we are holding here, trying to hold up near the highs, which is fine. But if we see this reverse, get back inside this channel at 265, that's going to be kind of my warning. Not just this pullback. I wouldn't even say a pullback to 265 because we have so much volatility in the market. We could do this again. And so even if we fall back to 265, that's just corrective. If we see it clear 265, that's going to be, for me, the confirmation that we are unwinding expectations of a healthy consumer market. The last thing I want to address is the earnings elephant in the room. We're into earnings season. We know that the tech sector is now going into its earnings season. We had Tesla and Netflix. And if we're seeing inflation and it's going to change or alter behaviors and purchase behaviors, or in this case, subscription behaviors, when it comes to these tech stocks, then we should start seeing them miss earnings. And Netflix did miss earnings. We don't want to think that just because the stock price went up that it didn't miss earnings. They missed earnings. They missed expectations. Their earnings per share came in at 211 versus the expected 221. Now, they did have higher revenue, but if you have higher revenue and lower earnings, it says it costs you more money to get there. Higher revenue and lower earnings means that you sold more, possibly charged more, but it cost you more to do it. And so this is not a huge positive thing, and yet the market is treating it like it is the best thing ever. We saw Netflix take off and rally up through here. We've seen it go from yesterday's close at 491 up to 553, and that 60-point move is equivalent to a 12.5% change. Is that sustainable? I'm going to say no, because it's also telling us that if it costs them more to keep their revenues going, yes, they may have more subscribers, but they're going to make less and less. And if they're charging more, which a lot of the streaming services are, they're going to start seeing consumers drop off as inflation goes up and as the cost of oil goes up. Let's take a look at Tesla. Tesla could be treated as a counter oil trade, and yet, as we've saw Tesla missed earnings, Tesla got knocked down, Tesla gapped down and basically did the same 12% down that Netflix went up. Tesla missed its earnings and guided it down as well. They missed their revenues as well. So they made less per share. They made less revenue, so they already had lower sales. And they also said 2024 is likely to be worse than 2023. All indicating that consumers' behavior and purchasing behavior is starting to shift. Now, if we are going to watch into the next days ahead, if we're to look at American Express tomorrow, that could be something that could be an indication to us. But really, it's as we get into next week. Next week, we are going to see more of the big stocks. We're going to see earnings from some of the home builders like Pulte. We're going to see General Motors, which we already saw miss in Tesla, and we've already seen Toyota Motors and Honda slip. We've already seen the tech stocks report, but we have Microsoft, Google, Starbucks, all that can be impacted very negatively by earnings season because consumers are starting to have to shift or choose what they're spending money on. I think it's fairly evident that Starbucks has already reversed from its highs. We're approaching the lows, the same low levels that we were at before. The question is, do you think they're going to perform like they did before? Are they going to report in and show that they made $1.06? Well, analysts are predicting they're going to make about 94 cents per share. That means that we should be getting back below this level and possibly pushing down sub 90. What you'll have to watch for is whether Microsoft and Google have better earnings or not because of AI. Are they seeing that they're selling more? Are they going to have equal to lower revenues with higher earnings? Because that would give you an indication that they are producing more earnings with less costs. And if they shift away from individuals, if they shift away from programmers and into AI and letting more of the heavy lifting being done by AI rather than individuals, that could be something you'd be watching for. So watch for revenues to be at or below expectations and earnings to be higher to be an indication that they're shifting away from employees into more AI usage. Same thing with Google. And also whether this lift is justified. Are we going to see higher earnings than last quarter? Same thing with Google. Let's go take a look at Google. And we can see record highs here. Are they going to have higher earnings than 155? Google, both Google and Google are supposed to expect $1.60. So they're saying we're going to continually make more money here. Watch for their earnings. Watch for the revenues and see if revenues are flat or down while earnings are up. If they're not, this could be overpriced and we should be expecting it to come back into probably to 140. And to circle back around and finish out with the Nasdaq did the exact same thing the ES did. We rallied on higher than normal volume yesterday, but failed and dropped all the way back to almost closing flat. And then today we created an inside day, a very flat body on average volume. This to me looks like we may have found the top. We may have found the top. I was looking for a 17,800 touch. We came in just shy of that. And if we can close above 17.8, we're going to 18,000. But if we don't get above there and we have more volume on the next down, and if PCE is one of the indicators that we're still fighting inflation and rates are not coming down, then the Nasdaq is likely to come back down into the 16.8 range over the next week. Well, that's going to do it for me. Watch that PCE number tomorrow morning, and we'll look forward to talking to you again next week.